Good morning, everybody, and once again, after quite a bit of a break for FIFA 22, and I'm here to discuss another question from financial accounting on the section B of the mock paper 2, question number 2. Let's stuck into the question now. The question here is about consolidation. The consolidation deals when you talk about IFRS. Consolidation is a standard regulated by IFRS 3, IFRS 10 mainly, and there are also some other associated standards as well, such as IFRS 13, fair value measurements, and also IAS 27, 28, and so on. Anyhow, at F3 level, at financial accounting level, such lengthy complications will not be that much appealing. So we will just try to see how to answer this question. The draft statements of financial position of Spider and its subsidiary company Piley at 31 October 2015 are as follows. Spider, Piley assets, they've given you non-current assets, land and building, plant, investment, blah blah blah, and then they give you the following information is also available. Spider purchased 180 million shares of Piley some years ago when Piley had a credit balance of 95 million in reserves. The fair value of non-controlling interest at the date of acquisition was 165 million. Now this with regard to non-controlling interest adjustment has specifically addressed after the revision of amendment of IFRS 3. At the date of acquisition, the freehold land of Wiley was valued at 70 million in excess of its book value. And this is something to do with the fair value adjustments or fair value measurement and the revaluation. This is combined with IAS 16 and IFRS 13. The revaluation was not recorded in the accounts of Piley. Piley or Ply or whatever. Ply's inventory includes goods purchased from Spider at a price that includes a profit of to Spider at 12 million. This is what you call unrealized profits, so which we may have to adjust. And at 31st October 2015, Ply owes Spider 25 million for goods purchased during the year. Calculate the total goodwill on acquisition by completing the following table. Now, ignoring the task the way that they ask in the requirement, we will answer the question in a comprehensive manner in order to benefit every viewers who may not also appear in financial accounting, ACCA, F3 papers. They may also could be useful for some other exams. We will answer the question in the complete way in a normal steps. So in doing this, what we are supposed to do is that we should first have certain workings. So the working number 1 is to have the group structure. Now what they are saying here, if you read, Spider is acquiring Ply. So Spider is acquiring Ply, and what else they say, and its subsidiary and 31st October blah blah, they say that, and the cost of investment is 660,000, and they also say here the Spider purchased 480 million shares. So 480 million shares they purchased. Now we also need to know how much is the total number of shares of the subsidiary. Subsidiary total number of shares 600,000. So if you see that into 100 will give you the percentage of ownership. Let me figure out using a calculator. Yeah. So I'm working out on a calculator. So 480 divided by 600, it's actually 80%. And the investment is given in the question, that is 660,000 in acquiring the 480 million shares from the subsidiary. The parent company is invested $660 million. So that is 660,000, and that is millions. So that is the information. And they also say that reserves at acquisition, at the date of acquisition, actually we need to figure out this is the time zone for subsidiary. This is the date of incorporation. This is the date of acquisition, and then this one is the date of financial statement or date of balance sheet. So now on this date, the reserves of subsidiary is how much? They say that here when Ply had a credit balance of 95 million. So that is one information. So that we need here. And further, they also say that there has been a revaluation to the freehold land, and it produced a 70 million excess of its book value. So the fair value measurement is 70 million in book value. And also they say NCI, fair value of the NCI at the date of acquisition, that also be in it, and non-controlling interest is 165 million. So this is the complete structure of the group, and these are some analyses that we may have to use in calculating or computing the goodwill. Now working number 2. So working number 2 will be calculating goodwill. So now we will compute the goodwill. So we need to take the fair value of purchase consideration, which is 660 million, and then fair value of NCI, and that is given 165 million. Now we take the total of these two, so we get 660 plus 165, that is 825 million. Now what we do is that we subtract the fair value of identifiable net assets at the date of acquisition. So the part of the net assets of any organization is mainly the share capital and their reserves, in other words equity. So we take the share capital of the subsidiary, share capital, if you see, 600,000, and then reserves, at the date of acquisition, reserves we have noted down here 95 million. And also we need to take the fair value measurement for the freehold land, that is 70 million. So we take the total of these three. So we have 600 plus 95 plus 70. So we have 765 million. And if you subtract 825 minus 765, and our goodwill would be 60,000 or 60 million. So this is the goodwill. So this is the working number 1. Now working number 2 is about unrealized profits. What happens here? Piley's inventory includes goods purchased from Spider at a price that includes profit to Spider at 12 million. So now Spider is the parent company, Piley is the subsidiary company, and Piley purchased from Spider. So this is what you call downstream, a downstream transaction. And in the inventory of P, there has been some items which the profits on that is 12 million. So this is the profit. So what we should do, we have our consolidated return earning, whatever the amount here, I should transfer to unrealized profit 12 million, and then I will have the unrealized profit account 12 million coming from consolidated return earnings, and then on the subsidiaries box we have inventory. If you check the inventory of the subsidiary, 252. So what we now do, we have to offset this 12 against here the 12. So this becomes 0, and here carried forward will become 240. So this is what the adjustment that we needed for the particular adjustment related to inventory. At 31st October 2015, P owes as 25 million for goods purchased during the year. So this is intercompany receivable payable adjustment. So now what we do is that we will prepare the consolidated statement of financial position. So we prepare consolidated statement of financial position at 31st October 2015. Now we have assets. We should just follow the same format what is given in the question. So under assets we have non-current assets. Under non-current assets what we have? Tangible assets. Even under tangible assets I have land and buildings. Now land and building, parent company land and building is 315 and the subsidiary 278. 315 plus 278, but please remember to add that extra 70. This 70 is the fair valuation adjustment with regard to the land and building belongs to the subsidiary. At the time of acquisition, the shareholders of the subsidiary have negotiated this. Here also one more thing you need to remember, in case if any additional depreciation to be calculated and incorporated into the accounts, that also you should not forget to do that. So let's work out the total of this 315 plus 278 plus 70. That comes to 663. Then we have plant and equipment. The plant, in other words, 285 and 220. 285 and 220, and there's no any additional adjustment related to this. So 285 plus 220, you get 505. Now what is the next item here? The investments that has we have already used it, and we calculated and arrived goodwill. So what should we do? We should first take the total of these two. So 1168, and the goodwill we calculated. What is the goodwill amount? 60. So 1228, and now we need to have the current assets. So what are the current assets item we have? Inventory, so if you look into inventory here, I have 357 and 252. 357 plus 252, but please remember that unrealized profits we need to subtract from the inventory. This is in order to be in line with or complying to IAS 2. So 357 plus 252 minus 12, we have 597. Then receivable, so I have 525 and 126. Here again we need to incorporate one more adjustment. The at 31st October ply owes Spider 25. So in the book, in the receivable of the Spider, there has been a 25 that receivable from subsidiary. So we need to take it out. We need to remove this. So 525 plus 126 minus 25. So I have 626. So next item is what? Next item is bank. So let me have the bank here. So how much is the bank? 158 plus 30. 158 plus 30. So 158 plus 30, 188. So we take the total of these three. 597 plus 626 plus 188. So I have 1411. So this is the total of non-current assets. So we take the total of these two. I mean, this is the total current asset and this is the total non-current asset. So we take the total of both plus 1228. So 2639 is the total. And 2639 we call it total assets. Then we have equity plus liabilities. Under that equity, remember in a consolidation, the consolidated financial statement will have equity or the share capital only of the parent. So we take the parent company share capital, how much? 1.5 million. And then we need to work out the consolidated return earning. Actually, I have to do the working. Let me do it here. Do I have space? Yeah, I have space here. So parent company and then subsidiary company as per question. So what are the return earning given in the question? 580 and 212. 580 and 212. Now I have pre-acquisition reserves, which is it was given in the question at the beginning. Let me go up 95. So I will take out 95 here. So I will have post acquisition So 212 minus 95, that is 117. And then I have to transfer to the parent. Transfer to parent 80% of this, 117 into 0.8. So that is 93.6. So 93.6 I add here. And then transfer to NCI, 117 into 0.2, that is 23.4. And one more thing not to forget, we need to remove the unrealized profit, that is 12 here. So we take the final answer. So this becomes 0, and this one 580 minus 12 plus 93.6, 661.6. And then we also need to work out NCI. Let me work it down, that NCI here. Now NCI at acquisition is given in the question. That is 165. So we take that. And then post acquisition is this 23.4. So 0.4 plus 165, 188.4. So now we come back. Consolidated return earning will be how much? 661.6. So we take the total of these two, 1500, 661.6. So 2161.6. And I have to add the NCI 188.4. So that is 2350. Then we have to go to the liabilities. I have payables 220 and 94. Now payables 220 plus 94, and then I need to subtract the intercompany payable 25. So 220 plus 94 minus 25, so 289. So this will be the total. Let me see, 2350 plus 289, 2639. 2639. With this question, we have done the complete working. Now what you do is we check the requirement here. So first they want the goodwill, we have done that, and then what they want, the balance sheet, which we have also done that. With this I conclude the discussion of this topic, and thank you so much for watching. Do not forget to subscribe my channel, like my channel, and also without failing press the bell button at the bottom, and be helpful to everyone. Share this to everyone. Thank you so much.